I'm going to be doing a little seminar here, or a little bit more information on a 2-1 buy down. So everybody's been talking about it. It's been in conversations for the last couple months anyway. I'm even hearing it at Christmas parties I'm starting to go to. So what I wanted to do was give a breakdown of what it actually means, number-wise, payments, how it works. We're going to do that. I'm going to show you a specific example and then go into all of that. So here we go. Let me share my screen with you. I've got a example I have created. So there you go. What I'm just showing you here is a conventional 30-year fixed, $300,000 purchase with 20% down. Now you'll notice the first column, this one right here, is the loan amount that it starts with, but it says year one. So remember, a 2-1 buy down is you take today's rate and you start, the first payment starts out at 2% lower than what the normal rate would be. The second year into the loan is 1% lower than that normal rate. And the third year is where the normal rate that you're locking in at and we qualify you with starts and takes over for the rest of the loan. So assuming today's rate 6.49 with no points, your first payment would be calculated based on 4.49%. Payment with taxes and insurance estimated in this option here, $1,564. Now, if we look at the normal rate, and you'll see cash to close, bottom line, it's the only year that has that because you're closing on it. That's when all the money is due. This is assuming 20% down, no seller help. This is $260 less than what you would see at that third year with the normal rate if you were to do a normal 30-year fixed and take today's rate. That's about a $3,100 savings that first year alone. So let's look at the second year. Assume the second year would be 5.49. Payment would be $1,688 based on the remaining principal and interest. Payment would be $136 less than what your third year is going to be, or the normal rate payment. That is about a $1,600 a month savings, or I'm sorry, annual savings right there. For a total of about $4,700 you'll save your first 2 years when you're doing a 2-1 buy down. Now, third year, your payment based on today's rate would jump to $1,825. So that's the first month of that third year, your payment would be the normal payment. That is with principal, interest, and taxes and insurance estimated with the $300,000 loan amount. Now we can do these conventional FHA or VA, but this is a conventional 2-1 buy down option. Now, all that is good. That's the numbers. We're great there. So let me jump back over here to you guys. The big question from buyers, even people when we're having conversations, is what happens if rates drop? Because everybody's predicting rates to come down at some point in the next year, sometime next year, or even early 2024, but I feel next year. Well, all great question. What happens with the buyer? So we've seen it's a win-win situation for the buyer when it comes to monthly payments. If rates were to come down, let's say 6 months into this loan, you buy a house, you do a 2-1 buy down, 6 months after you've been making payments, rates drop to 4.5%. Well, that's about where you are right now. And you say, I want to lock this in for 30 years. I don't want it to adjust higher next year or higher the following year. We can do a refinance. You can take in charge of that 4.5% rate. And with our special program, we're going to give you a $2,400 credit over the next 2 years. We've been marketing that out there. Your refinance, essentially, we're paying all the costs. Keep in mind, too, that there is also an escrow account with a setup for the buy down. So at the time you close, all the interest that is not being collected the first year and the second year is put into an escrow. It is paid out monthly to the bank to make up the deficit. Well, if you refinance after 6 months, there's money left in that account. That money just doesn't go away, doesn't go to the bank, doesn't go back to the seller. It's actually money for the buyer as a principal reduction, which means it reduces your loan amount when you refinance. Another plus for the buyer. In a situation like this, the seller is providing about 2.5% in closing costs. So that's a little bit less than 3%. This scenario has the buyer paying their closing, but the seller is providing the money for this 2-1 buy down. Still, it's a win-win for the seller as well. They're selling their house, they're marketing in a time they don't have to wait a year, year and a half for rates to drop, and they're getting away with paying less closing help than another buyer may come in and ask for 3.5%. So this is a great tool in a market like this for the buyers and for the sellers. Sellers, you can market this and advertise your property this way. Talk to your listing agent, and usually they're going to work with someone like myself to give them the numbers so you know exactly what that number is. If you were to sell at a certain price, here's how much you would have to contribute. So that's something that we do on our end. So keep all of this in mind. It's a great time to buy. You can negotiate your price. You can get closing help a lot of times, depends on the property and your location. And then you can do all your inspections. So don't wait for rates to drop. If we do that, you may actually be looking at another bidding war. You may be looking at a house, instead of getting it for the price or a reduced price, you may be competing with 4 or 5 other people and escalating it again. So you're right back to a higher payment. Even though the rates are lower in a year, if you're paying more for the house, you've got a higher payment. Should have just bought the house now. So hope this helps. If you have any questions, let me know. Happy to run scenarios. If you're a buyer, if you're a seller, put this together and show you exactly what it means to your bottom line or to your monthly payment. Thanks a lot. You guys have a great day. We'll talk to you soon.